Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates and how they have been impacted by the CPI report and jobless claims. Logan, welcome back to the podcast.
As soon as I bring up Brock Purdy on the podcast, now he's injured for 2 to 5 weeks, and I'm stuck with Mac Jones.
You did it.
I jinxed Brock.
You jinxed
man.
it. We have so much to talk about today. Oh my gosh, let's start with mortgage rates, which hit another yearly low today. Good news.
So if there ever was a labor over inflation day in the last few years, today's the ultimate day. And why do we say that? Is today's CPI came out. And if you looked at the data, the month-to-month CPI report was a little bit hotter than anticipated. The goods portion of the month-to-month data was at the hottest print we've had all year. And bond traders didn't care. They said, homie, we are all team Logan, labor over inflation. They saw the jobless claims go vertical. And whenever you see jobless claims go vertical in the week, something's up, right? So it's not an authentic data line. In any case, a lot of that came from Texas. Some people could blame the floods, stuff like that. But in any case, the bond market is so worried about being behind the curve that everyone not only bought the 10-year yield, took it below 4%, which means we're 19 basis points away from the low end forecast of the year. But it's been trading near 4% the entire day, even with some regurgitation of the data to the marketplace. The bond market didn't care. And we've always emphasized this for the last few years. The Federal Reserve can say all they want about the labor market, but if jobless claims breaks, doesn't matter. Right? Nothing matters if jobless claims break. So the bond market will do all the heavy lifting. They'll get well ahead of the Federal Reserve and deal with it later. And this is a really good example of labor over inflation on today, as the Federal Reserve is going to meet next week. CPI came in slightly hotter than anticipated. Didn't matter. Jobless claims, bond traders, we're buying. And that's taken mortgage rates just a little bit lower. But here we are, with inflation well above target, but at the lowest point of mortgage rates all year. Paper, rock, scissors, baby. Labor over inflation. Here we go.
Now, today's a great illustration of that because, like you said, we had both. We had the CPI come out, we had jobless claims come out, and it's clear to see which one won when it comes to mortgage rates.
Which one won it? And, to be near the bottom end of the range just means so much is already priced in. I always try to emphasize, people think oh, here comes 5% mortgage rates. No. We are modestly restrictive. The labor market is solid. Population growth is slowing down. We have a low unemployment rate, but we still are modestly restrictive. So as long as we're talking, how long does it take to get to neutral policy? Don't go into the accommodative camp, or they're going to start doing more. The bond market could only go down so much. And again, we're 20 basis points away from the low end forecast of the year. The mortgage spreads are better this year. A really good example of mortgage spreads, when Godzilla tariffs came in and the 10-year yield was at 3.87%, lower than it was today. Mortgage rates are still 0.25% higher than what we are as of this moment, because the spreads are better today. So on the rate side, good story. And it just makes a very interesting Fed meeting, because there's no more inflation reports, and there's no more jobs reports, and we get ready. Retail sales is next week, and the builder's confidence. But the question really now, is lower mortgage rates doing their thing?
Well, yes, but before we get there, we do want to talk about that, but I want to ask you a question, because here we are, like you said, we've been through jobs week. Now we've been through inflation week, and we got the jobless claims. So this is all the data that the Fed's going to have before their meeting. If they come in, everybody expects at least, 25 basis point cut. But is it going to be like last year, where it's already been priced in, so that doesn't move the needle at all on mortgage rates?
The bond market always gets ahead of the Federal Reserve rate cuts. So wherever the bond market is today, it's already pricing in the weakness. Remember, we flow with economic data first. The bond market, the Feds, they're old and slow for a reason. It's an institution that meets every 6 to 8 weeks. So the only thing that I could see that can possibly change this is that Jerome Powell says, I was wrong, Logan was right. I didn't look at the aggregate data. And we are going to start thinking about getting to neutral policy earlier. And then maybe the discussion of maybe when do we start talking about an accommodative policy? See, if you get into the accommodative policy stance, which we have never whispered in the last few years, then you got the potential of the 10-year yield, getting lower than 380 and staying lower. But we're not there yet. And I don't think they're going to do that. The big debate on X today was, are they going to cut 50? They should cut 50. And I go, this Federal Reserve cannot cut 50 unless there's a coup. If there's a coup and they get more votes, then okay. But I mean, Jerome Powell would lose so much face. And poor Beth Hammock. What is Beth Hammock going to say now? She's going to say everything's great. It was one report. How many reports do you get to say? It's just one report. That's there are rules on that also. So I don't think you get a 50, but the language gets to be a little bit more interesting because, I mean, let's be honest, GDP is still running at 3%. We're not, jobless claims isn't at the 4-week moving average of 323,000. Consumption is still holding up. It's not like we're regressing, but it'll be interesting if this is the first time they start talking, okay, we need to stay lower for longer. And just to make sure that the labor market, doesn't break on us, so we don't have to aggressively cut rates later on in the future, and just keep everything low, because you're going to need housing starts to pick up again. You need residential permits to pick up again. You need to start building homes again in this country, and for that to happen, the builders need to feel more confident that they can sell them. So that's how economic cycles have worked. So it's a choice. Now they've got all the data they need. So it'll be an interesting Q&A.
Okay, so from your perspective, given that this might be the lowest that we get, even even with that Fed meeting, because we're at 6.27% today, according to Mortgage News Daily.
If the economic data gets weaker after the Fed meeting, things change. So let's just do a hypothetical. Let's just say that after the Fed meeting, the Federal Reserve said the labor market is solid. We're still going to cut 25 bits, but we think the economy is fine. And then all of a sudden, the next 3 jobs reports are negative. Then that's not going to work. The Fed's moderate, so always remember, we don't care about the Fed rate cut or rate talk or any of that. We care about the economic data first, then the bond market, then the Fed comes in, because again, 65 to 75% of where the 10-year yield can range in is still Fed policy. And Fed policy is still today modestly restrictive. Okay, we are nowhere close to neutral. Obviously, we're not. Remember all the neutral talk, and everyone's like, we are neutral policy now. No, we're not. Oh, that's a whole different story. In any case, data first, Fed second, and then verbiage on what they want to see or not want to see last. But we always make sure to track every single economic data line daily and see how the bond market reacts to it. And I mean, how many people would have taken the 10-year yield would have been under 4% with inflation at 3 or higher in September? If I would have told any of the bond traders or anybody on X or that would have been the case. You know what I'm telling you? No way. We're broke. We're going to have to refinance $50 trillion in debt. There's no way the 10-year yield could go lower. Nobody would have taken that. But we do ranges for the year so we could explain, okay, well, this data line's getting worse. This means we have the potential to go lower. Okay, this data line's getting better, so there's more upside. But right now, for the most part, so much is priced in because the Fed is still modestly restrictive. They cannot get to neutral policy in the next meeting, right? They can give you different language. That's why the language is key. But there's no way they're going to cut. They're not going to give Trump his 1% rate cut or anything like that. Trump would love that, but obviously things are a little bit different now with the data, but I still think they just go a quarter and maybe give a little bit of a dovish take. But this Federal Reserve has not shown to try to get ahead. They have proven to me time and time again, they like to play catch up. Like Beth Hammock said to the New York Times, if things get bad, we'll play catch up.
Yep.
That's the name of the game.
Well, I mean, I think that's important to say because like if you're out there, you're a realtor, mortgage lender, LO, whatever, and people are asking you, and people know, oh, Fed is meeting next week. Should we just wait because rates might go lower? If I'm a LO, I'm like, you should lock now. If it's between this week and next week, it's not like you can count on things going lower next week.
Here's the one honest truth about housing economics. Millions of people buy homes every single year, every single month. The curve gets better when mortgage rates go lower, of course. But I don't know how many people like think, let's buy a house right when the Fed meets.
No, no,
You
no.
know,
But I'm saying, like, if you're in the process already and you're looking at, like, you've been in the process for the last couple weeks, month, whatever, but there's a Fed meeting coming up, your interest rates are very top of
it
mind if
is,
you're
but
buying a house.
there's also business contracts. This is why I've never liked that conversation, because you have literally like 9 to 10 business days to get something done, and you can't tell like the seller, oh, by the way, can we hold off the contract for like 7 days till the Fed meets? I really like, no, no. I mean, you get into a contract, transactions get done very fast these days. I mean, 8 to 11 business days, you could get something done. It's not like the old days where it takes like 45, 60 days. So whatever it is, I mean, if you're talking about a refinance, that's a whole different concept. But in terms of purchases, people have lives, and I don't know how many people are sitting there thinking, let's just wait for the Fed meeting or anything. But again, rates get ahead of the Fed. Rates can get behind the Fed. If the economic data gets better and the Fed is talking about rate cuts, well, the bond market could go up, and that's what happened last year. Last year,
Yeah.
we priced in way too, oh my God, we were pricing in a recession last year. And then when the economic data got better, it didn't matter about the Fed rate cuts. Fed policy was up here, rates were down here. They have to converge, right? And the conversion was we had more upside. This is why we create the Hodor line and the Gandalf line. You shall not pass. So I don't think we're going to get to Gandalf anytime. Gandalf's at 3.37. So, oh, could you imagine bringing Gandalf back another time? That'll be great. That'll be so much fun. I got more gear to get ready for that one.
It's true. People give you this kind of merch too, so that's exciting. Now, this is great. For today, we'll take the lower rate, 6.27. Great. Let's talk now, like what you wanted to talk about, what that does to housing demand.
So we always, we have our weekly pending contracts data on the tracker. We have our total pending sales data on the tracker. But purchase apps is always the fastest way to see. And again, my theory has always been housing data gets better when mortgage rates go below 6.64. So we really want to see what happens then. It's only recent that this has occurred. We've stayed elevated near 7%. We've had year over year growth all the time. I mean, it was like 31, 32 weeks of year over year growth, like 19 weeks of double digit. A lot of that are sellers that are selling their house, filling out an application, sitting there waiting for a buyer. So that can explain, because we're working from extremely low bars. This is why I always highlighted the extreme low bars. But if you really want to get good action there, the week to week data needs to improve. Now, the week to week data was slightly positive. It wasn't great. The year over year data looked solid. But in this case, now that we're below 6.64, okay, we've had 6 weeks, 5 positive, 1 negative, 6 weeks of year over year growth, 6 weeks of double digit year over year growth. That is what you want to see. You
Right.
just need 12 to 14 weeks of this, and then it really filters in the data like we've seen in the past few years. So we're halfway there. Hopefully by Halloween, you could get the whole 12 weeks. Last year was a good example. Last year, nobody thought anything was happening in housing, and I was like, oh God, they're already missing it again. We had, out of the 18 weeks, we had 12 positive, 5 negative, 1 flat. And then eventually it takes 30 to 90 days to hit the data lines, the sales that, and eventually it got to our tracker data, and people are still saying there's nothing happening in housing because there's no year over year growth. And we had a couple 100,000 more home sales, right? And then rates went up again. So in this context, we work with the ebbs and flows, but we have ways of tracking the fresh weekly data to look out 30 to 90 days, our weekly pending sales data, and we take it from there. So very positive, six positive, like a 6 week positive trend. We get another 6 to 8 weeks that we got something there. It'll be like every other cycle that I've seen with purchase application data. So far, so good. And now rates are even lower.
Yeah.
All a positive trend. We did this last year, right? We did this in late 2022, early 2023, but now, it's a little bit different with the labor data because jobs aren't growing at 230,000 or 170 or 140. They are literally very low. So we'll take the data one day at a time with that.
Okay, so we wrote a story. Flavia Furlan Nunez, our senior mortgage reporter, wrote a story about how refis are up. Now, are they going to be this huge wave? No, but at 6.27, what is the refi? makes
To
some
me,
sense.
we're clearing out all the 7.25 and above that, people, you easily can, we could easily have nobody above 7% mortgage rates anymore, because it's slowly moving lower, and there's enough time to get something done. So again, a positive in is that side. But last year, rates went down to 6% as well. So that the rate in term supply is lower because some people refinanced last year. So if you can get toward 5.75 and 5.5, then you could pick up a little bit more of that demand there. So yeah, it isn't surprising on a percentage basis. I don't talk about the refi market as much because of the housing economics of it is not as important to me as the purchase demand. But the year over year percentages, there's a very low bar there as well. There's not much going on. So you have these really big year over year percentage numbers, and that would make sense. Because if you look at the refinance market, it's been pretty much dead for a while.
Okay, so any other insights you want to bring on this incredible week?
I'm just asking everyone to encourage Sarah Wheeler to get me a pass to go to the Fed presser and let me cook. Let Logan cook. See, y'all, nobody's ever seen Logan fully unleashed. It is
Oh,
so much more fun.
listen,
It's even more fun than Logan live, but I have to I am always handcuffed to a degree
it's
to
true.
side
You
because
are.
Sarah looking
Listen,
at me
Logan,
going, no, don't do it.
we love you as an analyst, but you're not a journalist. And if you were a journalist, you would have to follow a lot of different rules. And your social, let's just talk about your social media. Okay. If you're a journalist, basically you cannot do anything that you do on social media. So as much as we love you, you don't send an analyst to do that. That's a journalist's job. So sorry.
Always be yourself unless you can be Logan. Then always be Logan.
Always be
It's a
Logan. I do think I wish someone would ask him some of those questions. Sometimes at the press, sometimes we get good questions on those Fed pressers, and sometimes you're like, I wish just someone would ask this.
just to let everyone know, I am sending in questions to reporters that I know are going to be there. So hopefully, if you hear
Yep.
something that sounds like me, everyone smile, take a cup of coffee, and put it in the air. And go, that's our pirate Logan Mohtashami right there.
And of course, the Fed gets to decide who they want to call on for these questions. So it's not just like, oh, well, we all are there. So anyway, thank you so much, Logan. Looking forward to talking again soon. And so glad that we could end on a high note, like we are at a yearly low again for mortgage rates. That's good news.
Slow and steady wins the race. Slow and steady heading down with bond yields and better spreads really gets the race to victory. It's much different than rates just falling down because of Godzilla tariffs and the markets were down. So again, if you guys all see a mortgage spread, take a selfie with it, smile, give it a hug, and say thank you so much, because rates wouldn't be this low if spreads didn't get better.
Also, I just feel like, we set the dates for our events far in advance, and they always seem to be incredibly interesting dates, like great dates for discussing the data.
October
October,
7th, Mortgage Banking Summit, Dallas,
it's going to be amazing.
George Bush Library, Logan Unleashed. We're going to
It's
put
true.
Sarah outside of the library so she can't yell at me anything, and I get to do my thing. So love it.
I love it too. Okay, we'll see everybody there. Thanks, Logan.